Mr. Liddy, I took a look at the 10-K that you filed about 2 weeks ago with the Securities and Exchange Commission. Are you generally familiar with the AIG 10-K?
Yes.
Thanks. We copied some pages for you. Do you have them in front of you?
I do. Someone handed it.
I want to ask you some questions. Let's start with page 153. This is a chart of shareholder equity, and it says the changes in AIG's consolidated shareholder equity from the beginning of 2008 to the end of 2008 were as follows. Beginning of the year, the shareholder equity was roughly $96 billion. You had $99 billion in losses realized in 2008, and somehow you ended up with a shareholder's equity of $53 billion. Certainly, 96 minus 99 means that without anything else happening, you would have ended up $3 billion in the hole. Is that correct?
Yes.
All right. Now, I see two large entries here. I was hoping you'd explain them. One is excess of proceeds over par value of preferred stock issue. This is $40 billion, and it was recorded on your books as an increase in the shareholders' equity. Can you explain who provided the preferred stock that you recorded on your books as a $40 billion increase in shareholders' equity?
I believe that is the TARP money that was provided to us.
So you recorded the TARP money in your books as essentially equivalent to profit, correct?
No, it's reported as equity, not as profit.
As equity.
Right. This is an equity statement.
All right, and equity is something that you get without any legal liability except to the same liability you'd have to any shareholder. Is that correct?
No, sir. I think it comes with a pretty heady liability. You have the liability of making whatever the dividend payment rate is that you have to make on it. And in our case, there's an expectation that at some point in time that money will be repaid.
Well, it's interesting that you say that because there's another line here that says $23 billion. And without that line, then your company would have been close to being in the red even by this accounting method. Without this, you would have been in the red. It says consideration received for preferred stock not yet issued.
It's the loan from the Federal Reserve. At the time this was prepared, we had not yet issued, or maybe this was the 10Q or the 10K with which we actually issued the 79.9% ownership that the Federal Reserve has of AIG.
So essentially what this means is that the taxpayers gave you $23 billion, and before you even gave the preferred stock to the taxpayers in return, you counted that as an increase in shareholders' equity for AIG. Is that correct?
Yes, it was in anticipation of giving that preferred stock.
All right, let's turn two more pages to the page 179. This is one that says the following table provides estimates of AIG's sensitivity to a yield curve upward shift, equity losses, and foreign currency exchange rate losses at December 31st, 2008. And you see the entry that says yield curve 500,000?
Yes.
Now that 500,000 actually corresponds to $500 billion. Is that correct?
I believe so, yes.
All right, so what this is telling us, this stress test analysis, is that if the yield curve, which is simply the difference between long-term rates and short-term rates, increased by 100 basis points, which is 1%, then you're telling us that AIG would be on the hook for $500 billion. Is that correct?
I'm not sure. I'm looking to see whether those are billions of dollars or hundreds of millions of dollars, and I don't see the designation in front of me, sir.
Well, look above the words yield curve where it says dollars in millions. Do you see that?
Yes, I do.
Okay, what's 500,000 million dollars?
Yes.
Okay, so is it correct then that according to your own 10K, if the yield curve changed 1%, if long-term rates went 1% higher and short-term rates stayed the same, then you would be on the hook for $500 billion.
Well, you'd have the offsetting effect of the impact on the liabilities.
Well, why isn't that reflected here in the stress test?
You know, I can only assume that stress tests are put together according to a very specific formula so that they can be compared from one institution to the next.
Well, that sounds like an awful lot of stress for the taxpayers if they're on the hook, doesn't it?
And to that exact point is why we wanted to make certain that the AIG FP business gets wind down in an orderly way.
Let's take a look at the next page because time is short. If there were an earthquake in San Francisco, an earthquake in San Francisco, then according to your table on page 184, that would cost AIG $8.6 billion. But if interest rates increased 1%, that would cost AIG $500 billion, correct?
Well, as I said, on the second of those pages that you called out, there's an offset on the liability side. On the page on the insurance, the cost of insurance, it would be $4,966 million after reinsurance if there was an earthquake along the lines of what occurred in the early 1900s.
Well, what exactly was AIG insuring? The entire U.S. economy?
I don't know, sir. That's been my point, is that we are a very good insurance company with an internal hedge fund attached to it. We need to wind down that internal hedge fund quickly and efficiently so it doesn't cause the taxpayers even more distress.
Thank you, Mr. Chairman.
Mr. Peters of Michigan. Mr.
Yes.
Peters.
Thank you, Mr.